Welcome to Macro Bites with EY-Parthenon Chief Economist Greg Dacko. In this episode, Greg is joined by Rahul Chandarana, EY-Parthenon America's banking and capital markets sector leader.
So there's a lot to discuss. We are currently in an environment where the U.S. economy is essentially characterized by two features, I would say. On the one hand, you have resilience in economic activity, and on the other, you have polarization. Resilience because there are affluent consumers, AI investment growth, as well as asset price appreciation with stock market gains. But at the same time, there is some polarization. Not all economic actors are created equal in the face of all of these shocks. How is the banking sector navigating this fragmented environment?
So let's break it down, Greg. There's two separate segments when it comes to banking. So the commercial segment, that is a little bit different, looks at things broadly from an inflation perspective, from terms of tariffs and some of the other pressures they've faced. The tariff uncertainty has not helped the commercial focus banks have had. On the consumer side, things are a lot more stable. Banks are focused on the mass affluent market. They're focused on their private banks and how to make consumers, the top 10% of consumers, a lot more money at this stage. So there's a little bit of a diversification in what we're seeing in the market at this stage.
We're not seeing much job growth. And as a result, income growth is under pressure. And that is creating some pressures in terms of reduced savings, in terms of increased credit use, and potentially in terms of rising delinquencies. Are some of these fragilities starting to affect the banking sector?
If you think about where the banks are today, the larger banks are heavily focused on things like private bank and the mass affluent segment. The smaller banks are focused on consumer experience, but across the board, right? A very geographically focused experience. So I think there is some disparity in the way, the customers are segmented across all the banks and how they'll come into focus going forward. Are you seeing interest rates, Greg, a little bit driving some of that change in the mass affluent market?
Yeah, I mean, what's interesting is that given the fact that inflation is still above the Fed's 2% target, you're seeing many policymakers at the Fed still hesitant to ease monetary policy further because they believe monetary policy is well calibrated today given economic fundamentals. Are you seeing some of these drags from higher interest rates onto the banking sector?
Absolutely. I think that, and you mix that in with inflation. And I think especially for the smaller banks that are dependent a little bit on banking the consumers in rural areas, there will be an ongoing recalibration of how you invest in the right consumer.
So Rahul, in this environment, we have a lot of diverging forces when it comes to growth, when it comes to economic activity, when it comes to interest rates, but there is a lot of enthusiasm around merger and acquisitions. Can you tell us a little bit more about how the banking M&A environment is faring?
So banks have already had a banner year in 2025. Most amount of bank deals since 2008. So we've clearly, already, and we think 2026, when we speak to C-suites of clients and board of directors, we think 2026 is going to be even more.
Yes.
There is concepts around technology and buying more deposits and being better products to consumers all coming together at the same time.
Yeah, and we're seeing that at the macro level as well. Our deal barometer, which looks at M&A activity, sees strong growth in both volume and value as well. I want to pivot a little bit to the regulatory environment because we're seeing a lot of deregulatory push from the administration, but we're also seeing a new framework being established for digital assets, including for stablecoins. How do you view that from a banking sector perspective?
So we're working with a number of clients that see digital assets regulations coming in as a very strong tailwinds in the sector.
Yes.
There's a huge amount of upside, Greg, right?
Yeah.
You're talking about payments, you're talking about offering new products. And we're helping board of directors today coming up with an entire new framework on the way you offer digital assets as part of banking. So there's a lot of excitement in the space. There's a lot more regulations coming, which will result in a lot more product offerings for bank consumers.
How are we helping our clients when it comes to AI?
Two different ways, Greg. First is on growth. Use cases around how we serve our consumers better and how we make technology faster and makes bank more efficient. The second is around risk framework. So coming up with responsible AI in the risk framework aspect where we're handling consumer data in a much more valid concern.
How would you advise a CEO, given everything we've been discussing, to navigate this environment when it comes to the banking sector?
So I think three ways, Greg. I think the first one is going to be around this, concept of strategic growth. Like where would you spend your money depending on where you are and where you want to be 5 years from now? Clearly it's different for each segment of the banking market, but it's a very relevant conversation topic. The second one is going to be around responsible M&A acquisition, right? So it has to be productive, but I would call it a disciplined M&A market. The third one is going to be around technology and AI spend.
Okay.
Being first in the market is important. Investing in responsible AI is even more important.
Thank you very much for those insights.